Hello and welcome back to Cryptocurrency Trading, How to Profit Daily with Technical Analysis. You've made it through the first module, and now we're looking at indicators and oscillators. In this first video, we'll talk about one of the most basic indicators, an exponential moving average. Now, an exponential moving average is typically used, but there are other moving averages such as simple moving averages and the like. Really, at this point in time, all you need to know is that moving averages are simply a plotted line on a chart that goes right along with the trend by a certain amount of periods. So what I mean by this is, for example, if you have a 20 moving average, it will take every plotted point that makes up the line, will take the previous 20 candles, the average price, for example. Now, it does get a little bit more complicated than that with the exponential moving average. It puts more weight on, say, the first 10 than it does the second 10 candles in that 20 range. But if you were to, for example, see where the moving average was at this point in time, the 20 EMA, it would be the average closing price of the last 20 candles with more emphasis put on the closest 10. It just makes it react a little bit quicker than a simple average, which would just be the average of all 20 of them, with each candle being equal weight. And really, what moving averages do is they just give you an idea as to the overall attitude of the market. So for this example, I'm going to use a Litecoin daily chart. And moving averages are very simple to plot on TradingView, like anything else. I'll go ahead and click the indicators. And you go down and you look for moving averages. And in this case, we'll use the exponential. And as I click that, you'll notice that this comes online here. I'll go ahead and look at the format. And I'm going to make this 9 moving average, exponential moving average, red. You can see that I can also format it as per usual. If I hover over the indicator itself, it's a little difficult to do sometimes because it crosses the candles. So I tend to use that. I'll make this a little thicker. I'll go ahead and do that. Click OK, click away from it, and you can see that I have this moving average. And if you were to run the calculation, it does in fact sit the average closing price of the last 9 candles, in this case 9 days. So what does this tell us? This tells us that we are most decidedly in a downtrend. But you can see that from simply looking at the chart. But some people will look at moving averages as a confirmation of the overall trend. Something that is a bit interesting in this chart, you can see that the moving average is clearly dropping there, but it kind of flattens out. It drops again as price continues to accelerate, and it's kind of flattening out again. So the most recent move in the market has been relatively flat. So that gives you an idea as to the strength. When you zoom way out, you can see that there was an extraordinarily strong uptrend in the bubble top. And you can see that we rallied, we changed, and then fell. Now, some people will simply look at a moving average and say, okay, I'm only trading in that direction. Now, there are other moving averages, obviously, that you can use. So let's go ahead and add another one. Let's go ahead and add a moving average exponential. And I will format it up here because it's easier to do. I'm going to make this blue. I'll go ahead and make it a little thicker. And the input here, I'm going to put 20. So this is a pretty common moving average. The 20-day moving average. So this brings up an interesting point. You can see that clearly one of the moving averages reacts quicker than the other. That would be the 9, and that makes sense. That's your short-term momentum. What you're looking at is the very basics of a trend following system, a moving average crossover system. Some traders will enter short when the fast moving average breaks below the slower moving average because the most recent momentum is to the downside and it's broken a certain psychological support there in the form of the 20-day. And they will short there, and they will buy there, and they will short there, and so on. This is flat, which brings up the next point with these. These do not work well in a flat market. If there's no trend, you can get crushed trying to trade a trend following system, such as a moving average crossover system. So the other thing that you want to pay attention is the overall attitude of the moving average. And when I say attitude, I mean like a plane, the way, the angle that we're trading at. Clearly we're in a downtrend there. You can see clearly that we broke to the downside. You can see clearly we were in a downtrend before that. Right now, we're pretty flat, so there's no point in shorting. Now, yes, it goes with the longer-term trend, but you would have gotten chopped up for several weeks at that point. And so looking at this, you can see how you enter when it crosses. So you would have entered here long, you would have bought, and you would have exited here short, would have been a small profit. Here, you would have shorted, and you would have bought there, would have been a much bigger profit. So it's not necessarily the most optimized system, but it is something that's used quite a bit by longer-term traders especially. Some short-term traders will use it, but you have to be pretty nimble, and you have to realize that you're going to, by its very nature, get into the trade a little late and get out of it a little late. It is a lagging indicator. It is looking back to perform these calculations. So another potential, and I'll go ahead and close the 20 out, but another potential use for moving averages be the format here. I'll go ahead and change this to 50. I'm going to make this orange just to differentiate it. Okay. So the 50-day moving average is a very common one to be followed by technical analysts. It is dynamic support and resistance quite a bit. Not always. And again, this is kind of one of those things you have to follow the overall trend, but you can clearly see how the market has reacted to it quite obviously several different times. So obviously somebody follows it, right? But this kind of flat moving average got chopped around. So you clearly could have been in some trouble here. This is why moving averages are typically placed with some other type of indicator or support and resistance, that type of thing. And then the final, and you may hear this, this is something that you hear more of maybe in the stock market, but you will hear this occasionally. Something called a death cross. And a death cross is, I'll go ahead and make this black. A death cross is typically referred to as the 50-day and 200-day moving averages crossing to the downside. A golden cross would be the other direction, would be crossing to the upside. So, for example, the golden cross way down there led to a lot of gains. We had a death cross here, and you can see we've fallen. At that point, we were at roughly 126. We're now at 56 as I record this. The 200-day average is considered to be longer-term support and resistance. The biggest problem that you'll run into with cryptos is that, quite frankly, most exchanges haven't been trading enough to make the 200-day moving average that relevant yet. This is more of a long-term kind of buy and hold strategy. But be aware that there is such thing as the golden cross, which is bullish, and the death cross, which we have recently seen, which is bearish, and will send a lot of technical algorithmic traders into a frenzy. Again, though, something that should be used right along with certain types of support and resistance. And even though it's a relatively young market, you can see that the 200-day moving average has acted as both support and resistance as we pass through it. Again, though, this is more longer term type of buy and hold trading, but be aware that these situations do exist. That's it for this video. In the next video, we're going to take a look at using the MACD oscillator.